Welcome to Going Long with FCLT Global, the podcast that dives into the world of long-term investing and strategic decision-making, hosted by Sarah Williamson. Going Long features thought-provoking conversations with some of the brightest minds in finance, economics, and business today. Each episode will bring you exclusive interviews with renowned executives, investors, and experts who are driving change in the world of finance, getting their unique perspectives and uncovering strategies that have shaped their success. Whether you're an investor, a business leader, or simply curious about the forces shaping our global economy, join us as we explore the power of long-term thinking. This is Going Long with FCLT Global.
Welcome to FCLT Global's podcast, Going Long. Today, our guest is Jonathan Hausman. Jonathan is Executive Managing Director for Global Investment Strategy at Ontario Teachers' Pension Plan. He leads his team in developing strategic responses to emerging global themes and develops and cultivates crucial investment relationships for the fund worldwide. Prior to joining Ontario Teachers, Jonathan was Executive Director at Goldman Sachs, where he managed sovereign risk strategy. He's chair of the Canadian Council for the Americas and is a senior fellow at the Munk School of Global Affairs at the University of Toronto. OTPP and Jonathan have been active members of FCLT Global since our founding over 7 years ago. So thank you for joining me today, Jonathan.
Thank you.
So we've got lots of interesting questions for you, but let's start with a little bit of background for our listeners who may or may not be as familiar with the Canadian system. There's a famous, Canadian model for managing pension assets, and OTPP was really the one of the first emblems of that model. Can you tell a little bit about what that model is, what's important about it, and how that sort of shaped your history and who you are today?
Of course. Well, first of all, thanks very much for having me on. Very happy to answer these questions, and I think best to start with who we are and how we got here. The so-called Canadian model, which was originated at Ontario Teachers in 1990, was really the confluence of a number of factors. First, there was a thinking inside the government of Ontario, which is one of the sponsors of the fund, that it is much better to create off-balance sheet a corporate that can manage pension assets. In this case, on behalf of the teachers who live in Ontario, there's about 335,000 active and retired teachers that we work for, instead of having this department, essentially, of the government. And so that was the first thing. I happen to have been in that government. It was my first job working for the Premier of Ontario. Wasn't my file, as it turned out. The second factor was that it was a period of real innovation in asset management. And so we were really creating an entity that would follow a more rational model of allocating capital, looking for long-term returns to meet a specific defined benefit objective. And then finally, really, is personalities. We had brought together a really fantastic chair, who was the former central bank governor, Jerry Bowie, as well as our first president, Claude Leveaux, who was a really legendary person in the investment area, particularly on the topic of corporate governance, and an actuary to boot. So bringing all those things together, you got an organization who had basically two main characteristics. One was independence and autonomy. So we were able to pay the rates that were required to bring the best talent and to attract people who could manage these assets successfully and reach our objectives actuarially. And then second, really developing an increasingly specialized capacity to internalize or to manage internally many, and in this case, over 80% of our assets, which really was a cost advantage for the teachers.
And I think that this model other people have tried to replicate it over time. I think other people in Canada have, but that combination of investment innovation and professionalism, if you will, and independence politics, independence from the government, has been hard for other countries to replicate. Do you think that was is that something special about Canada and special about that time, or do you think other people could replicate this?
Well, people have. I think you can see echoes of this in the UK and in Australia. It is I guess something is somewhat special to the Anglosphere, but the model is universal. And I think what you're seeing is a general gravitation towards more professionalized management, more delegated authority, which is a sort of a cardinal rule for an organization like this one. And ultimately, you're seeing other organizations follow in that direction. It's just a good idea, and it is best for the fiduciaries, and ultimately best for those who have the contingent liability, which is often governments.
Yeah, that makes sense. So one of the things that you've talked about sort of since the beginning is the time horizon, and OTPP is known as a very long-term investor focused on those long-term. Maybe that was your actuary founder, but really thinking about the time horizons of the liabilities. That doesn't mean that you don't invest in things that turn over more quickly, but
Right.
how do you keep that long-term time horizon in mind in the midst of the everyday markets that go on?
Yeah, well, it is really about having one client, and the liabilities are 60 plus years long. Our clients is the group of teachers, both retired and active in the province, and we have to be cognizant of being able to deliver over the long term. Otherwise, but the promise that we've made, that is really our mandate, will not be fulfilled. So it is because of that intensity and focus on that client, which is that's a family, it's a household, that ultimately drives, I think, our long term focus. I would say, just as you have iterated here, not everything we do has a duration of 30 plus. Obviously, we're involved in short term markets. We're involved in capital markets. That's my training is in capital markets. But when it rolls up to the top, in the way that our asset mix looks and our overall portfolio strategy is conducted, the mindset is a long-term mindset because we have a long-term objective.
Yeah, and part of that long term is shifting with trends, but also being resilient to shocks that come up. And I know that's something that you've been thinking about,
Yep.
particularly at where we've got some of the things we're navigating right now, whether it is the changes in the energy world, geopolitics, AI, other sorts of trends that are coming at us. How do you think about tackling, keeping that long term mission, keeping that long term focus, but also adapting to these very very important trends
Yeah.
that continually arise.
Yes, it does seem a challenging thing to do, but I actually think a simple and hopefully not simplistic adage is important, which is our business is really the long term. I mean, as I said, we are looking at the lifetimes of our teachers, and the trends that you're alluding to and other ones too are ones that will shape the risk and return environment in the next 10, 20, 30 years. We have to be focused on that. Now, you could clearly see a difference between a group whose time horizon, like a hedge fund or the trading desk that I used to work on, could be denominated in hours or days. You can certainly see that would be inappropriate for a group that's looking to understand these trends over the long term. So what I advocate and what I believe we've tried to do at Ontario Teachers is to create capacity and bandwidth around tracking long-term secular trends and being able to convince ourselves that we've got a better read. Nobody has a perfect read because we're not clairvoyant, but a better read than others in the marketplace about what these trends mean, how they ramify in portfolio decisions, in businesses we want to buy, businesses we want to sell, and ultimately the kinds of human capital we want in the organization to be able to surf these trends. And I do think it's surfing. You can't anticipate them completely, but you can certainly move and zig and zag in ways that perhaps provide you a greater alpha result than someone else. So we are very focused on three components of that strategy, what we call prepare, act, and innovate. So to prepare is a very different thing than we would have said 5 years ago in the environment. Prepare really means you have to put real energy and real thought and pre-work into trying to make the organization resilient in the face of things that you can't anticipate. And that sounds simple, but actually it means bringing together folks who may be working in different silos of the organization, bringing that together with some thinking that is being done by a dedicated team on what do these trends mean? What are the implications for an investor like us, a pension in the long term? And ultimately trying to build that musculature inside the organization so that you don't treat every crisis like it's the most terrible thing that ever happened and you're running around with your hair on fire. So that's a tall order, I realize. Never to be confused with trying to predict the future, but it's really about building a resilience in the organization in the face of a number of shocks. And you'd say, well, why is that so important? We've had arguably 3 1 in 100-year shocks in 3 years. So presumably this is something that's become part of the architecture of our system. So, we have to, as best we can, prepare. Act, conviction. It's all about conviction. There's no formula for investing in this era, in my view. It's all about gaining conviction. You can only do that by learning, recognizing that you don't have all the answers, and those answers are out there somewhere. Sometimes they're nowhere, but sometimes they're out there and you need to find them. Partners, working with partners who may have more specialized knowledge than yourself, and building capabilities inside the organization so that you can act. So in a way, these are connected, because if you have a resilient organization, you preserved some psychic capital. As traders, we all want to have the ability to react instead of curling up in a ball and hoping it goes away. So prepare allows you to act with conviction if you've done your work. And the innovate is that you have to be open to different ways of doing business. I guess the most topical area today is artificial intelligence. People are doing business differently as a result, I think, whether you're in public markets or you're in private markets. So those are that wouldn't be the only way we'd innovate, but it's just a maybe topical example. That's what we're trying to do. Now, how well we do it is yet to be seen, but that's what we're trying to do, because we recognize that we are in a different investing era today.
I really like your analogy of surfing, right? You've got to sort of ride the waves a little bit and not trying to predict. Sometimes people say, well, I don't know what's going to happen in the future, so I can't get ready for it. And you've taken really the opposite approach, which is, yeah, we don't know what's going to happen in the future, but we've got to get ready anyway.
Yep.
Yeah. And innovate and adapt as you go forward. Just on the AI front, one of the things that we've been thinking about a little bit is the interaction between companies and investors and how AI is changing that. And so if you think about, probably when you and I started our careers, there were humans with a blank piece of paper who kind of sat down with the company and humans talk to each other. We've come a long way already from there, which is obviously quant models and many, many other things. But where are we going? Are there no humans anymore in the public markets, or and maybe I'm asking you to predict what you just said you're not going to do, but how do you expect that kind of that investor corporate interaction to evolve as AI takes center stage?
Yeah. So we have, of course, a healthy dose of private assets in Ontario Teachers. It's sort of one of our flags, but we're certainly active in public markets as well, for sure. Be that in debt or in equity. So the answer, I think, is that the goal that we would actually have even greater human involvement, but on the right things at the right time. One of the things that's problematic about the value creation approach, if you're talking about private assets or looking at the stock selection and monitoring, is that the signal often gets mixed up with the noise, and you spend a lot of time on the noise. What I think these kinds of tools, and that's what they are, tools, ChatGPT, et cetera, what they can do is try to eliminate more of the noise and emphasize or accentuate the signal. Signals are for human beings. They're not for machines. And when you're talking about private assets, you're talking about being able to use these tools to identify the true kernels of insight that are required to value create. And we're talking about stock selection, et cetera. It's about categories, being able to define categories using, let's say, people use a co-pilot, for example, but it's a co-pilot. It's not the pilot, like in the movie Airplane. We're not going to have anything like that. And that co-pilot is there again to limit the noise and accentuate the signal so that we can make decisions. And why can't you rely on a machine to do that? Because the decisions increasingly are linked to that analysis of the business environment, which only human beings can do, because it is based on, intuition. It's based on human capacity, and human capacity, I wouldn't want ever to be underestimated. The human brain is still a pretty awesome piece of equipment, able to pull together things and integrate them in ways that machines simply cannot. And that's what investing is. It is essentially pulling together lived experience, these kinds of signals combined with gut. We call it gut. Gut is essentially just the sublimation of a lot of pieces of information that we don't have the capacity to calibrate, but it's all there. And that's how we think investors will succeed using these tools. And you got to use them because you can get left behind.
Yeah. Okay. That's really helpful. So switching gears a little bit to a global perspective, you mentioned that OTPP has offices around the world, by Hong Kong, Singapore, as well as obviously Toronto, New York, San Francisco, and so on. And the geopolitical relationships have become much more challenging. Both the U.S. and Canada have had their issues with China, obviously. But it's really critical. The global side is really critical for long-term institutions. Back to your signal noise, your information rhetoric. How do you divide what's really going on versus what's on the headlines of the newspaper every day, and then how do you incorporate that into where you're actually going to put your capital these days?
That's a very important question, and I'll respond to it this way: the geopolitical paradigm has changed. We saw the first contours of this change back in 2017-18, and we started talking about it. The change is not something that quickly changes back. These are epochal changes. These are changes that any investor needs to take full account of and adjust or adapt, innovate their investment strategy. We, as it relates to geopolitical phenomena, we believe that there are two ways that one can thrive. The first is to focus. So I think you were as well, an investment bank for many years, and we used to cover in our strategy group 45 countries. And it was an era of what I would describe as hyper-globalized environment where you could just as easily be working in Belgium as in Bermuda, as in Bahrain, and the rules all sort of felt like they're going in the same direction. Open markets, open societies, open capital. And the truth is that is no longer the direction. It has become more fragmented, and it has become much more difficult to be in any way confident or have conviction in so many geographies. So focus is the answer. It is an imperfect one because, of course, it's hard, but it is the first and necessary step. So we have reduced the number of geographies really super focused on, which is not to say that we don't invest in many, but we're saying we can develop real conviction in a smaller number of geographies because of the complexity, fragmentation, and ultimately the breakdown of this hyper-globalized system, which was probably unnatural anyway, to be honest. And historically, that has been largely the case. The second thing is to understand intensely that we're no longer talking about the traditional notions of sovereign risk, which is something I used to do when I was in my previous career. That was usually almost always about the country and the things that the country would do to you. It was very simple. It was developed by the oil companies in Britain in the 1970s. And obviously a really good reason to be worried about such things. But actually, we live in a world where the challenges come from almost anywhere. So it's a two-way street. So you mentioned China. So the issue is not just the question that China is moved in a certain direction. There have been changes, no question, which we take account of. But there's also the relationship of China and the United States. That dynamic creates all sorts of risks. And then we have to recalibrate those risks as it relates to what we think the return will be and what the downside risk could be to us. And adjust accordingly. In other words, risk runs both ways. It runs from Washington, it runs from Beijing. And that's a reality of our world. It's a world that we're not that comfortable with. We sort of thought we put paid to the Cold War many years ago. It may shock you to learn that while I was writing my thesis on the Soviet economy in 1989, 1990, the Soviet Union disappeared. So it kind of changed my career plans. So, we thought that was over. Well, I'm not prognosticating a Cold War. I think that's very charged language. But I do think that those risks do run both ways. And we have to be respectful of the fact that there are things going on that are a lot bigger than us. These are global strategic questions taking place in capitals. And as a result, we need to adapt our strategy to it. And so, as is known, we have put a pause on private investing in China for a while. This is public knowledge. And we felt and continue to feel that this is the prudent approach given the environment and its changes.
Right. Well, you mentioned that we've had three major shocks, one in 100-year shocks in the last, what was it, three in the last 3 years or something? And
3.5 or so, yeah.
Geopolitical. Well, I'm not sure which one of your three. What, COVID? Yeah. What were your
COVID.
three? Yep.
Absolutely. So COVID and the response to COVID, which created a new financial paradigm, among other things, but clearly we are in a very different financial paradigm than we were before. And of course, the invasion of Ukraine by Russia, which changed the geopolitical tectonic plates significantly, with significant economic follow-on impacts for Europe, for global South, et cetera.
Right. Okay. All right. That's very helpful. And it sounds like part of your focus strategy then is having people in these markets who really, really understand. And that's that's what you mean by the focus is not that we spread the peanut butter everywhere, but that we're going to have people in a particular market. They're going to really understand. They're going to be part of that market. They're going to really understand that market. That's
in whatever mode that is appropriate to the organization. Not everybody's going to have an office in every country. We don't.
Right.
But to have the capacity to build conviction, however you arrive at it, that's the key. It requires conviction because, as I say, the old model of, well, it's a little bit like this, so we'll do this in this geography because we did it in that geography, which was sort of the investment banking perspective of the 1990s, which I grew up in, it doesn't apply so well.
Right. No, it's got to be bespoke for every place. Okay,
Yeah.
Let's talk a little bit about climate. Obviously, it's a critical thing for investors, for the world. And I know it's one of OTPP's priorities. You've published a portfolio carbon footprint for some time. You've made net zero commitments. How do you really think about translating what you're doing in your portfolios and with your companies into, a real impact on the planet? In other words, some people are, how do you really use capital to make the world a greener place?
So really two things. The first is, and I referred to this term conviction, which is a word I obviously like, because I think it's equally important in the climatological realm. You have to believe that you can make a difference with the companies you own, the assets that you have under management. You have to believe that, because climate change and the mitigation of it doesn't happen through words and through commitments. It happens through action. And what we've tried to do is we've tried to apply our activist approach. And I use that term, I mean active, meaning taking actual actions as opposed to just buying indices and stuff. Our active management approach to the question of climate change. And so that means we did not choose years ago to pursue, as some of our peers did, a divestment approach as the first resort. We don't believe in it. Because what we know, what I think is maybe increasingly evident today, is that is great for your story and makes it look good on your balance sheet, but it doesn't make a dent in mitigating climate change. It hands the problem to somebody else who actually may be much less interested in this than you are. So we just didn't see how that was a solution. A solution is you engage with the companies that you own, whether little pieces or big pieces, and you do everything you can, whether it's proxy votes or whether it is the value creation process within the companies, the private companies, projects that you own. And we have a lot of those, as I said. So that's the first point, active versus divest. The second point is we also recognize that this is a process. This is not something that you can do and demonstrate immediate satisfaction, because that's not how investing is, and certainly not for us. And so we tried to put the right incentives in place, the right mechanisms in place at the fund to reach our net zero goals in a realistic fashion. But the net effect of it is to ensure that the incentives for our investors is to go and find less carbon intensive things than they did before. So we linked our net zero commitments to carbon intensity because it creates a natural gravitation towards things that have less intensivity, which reduces over time the absolute level of carbon in our portfolio. And we will meet those targets. Just to reiterate them, so by 2025, we will have reduced the carbon intensity of our portfolio by 45%. That's with a 2019 base. And by 2030, it will be reduced by 2/3 or 67%. That's our commitment. And we're on our way. So that is about incentives. But ultimately, you asked it, I think your question was very well phrased. You said, well, that's great. What are you doing with your portfolio? But how are you having an impact? And so we can have an impact, absolutely, with the portfolio footprint we have, and we're going to meet those targets. And I think we've shown that we can have a more virtuous outcome. But we also think that we need to use the levers of investment that we have to make an impact even well beyond the portfolio footprint of Ontario Teachers. And that is something we call high carbon intensity transition assets, which we've allocated a certain amount of money to, around $5 billion, as announced relatively recently. And the idea is that we would be looking for opportunities to be involved with assets that have very significant carbon footprints, many times bigger than Ontario Teachers, and use the levers of our capital, our investing acumen, our partners, which is going to be critical in this, and actually make reductions that are visible and demonstrable and truly make an impact beyond the portfolio footprint that we have. This is aspirational. This is what we want to do. We have a program. We have people who can do it. The opportunities obviously have to be there, and we're looking for them. And we have one that we worked on already, but we want to do more at a bigger scale. So that's an aspiration for and an ambition of our fund, and we've tried to put money behind it.
So in other words, don't run away from those dirty assets, but buy them up. Yeah.
And you know what? Our constituents and many stakeholders, even ones that have been critical of us in the past, get it. They're like, yep, that's rational. And it's hard work. And you have to find the right partner, the right asset, right plan. But we've opened our minds to it and create structure around it.
And are you using carbon, as you think about the incentives to either decarbonize these things or to invest in less carbon intensive assets, are you using carbon pricing to do that, or other mechanism? How are you actually getting that? What incentives, how do you bake this into incentives at this stage? What I'm seeing is a lot of people are sort of in the, to your point on divestment, they've got a yes, no mindset. Yes, we'll buy this. No, we won't. Versus more of an optimization mindset, which is how do we get this and make it better or optimize the situation, which is more the way an investor traditionally thinks than just yes, no.
That's absolutely right. So you've asked really two questions. One is more philosophical, one's quite methodological. So the methodological question is, we are using pricing more or less under the hood of the total fund management, which I actually do not run. It's my colleague, Steve. But it is part of the thinking that goes into how we ensure that we reach our carbon targets. So it informs the way in which allocations are made and the way in which asset classes respond to those incentives. The philosophical question is really about, how do you make those decisions? I think that it's partly cultural. I think that, you have an organization that is becoming increasingly resonant with the carbon dimension of their investing. I mean, it's just a constraint, right? That there's all sorts of constraints. There's capital constraints, there's risk constraints. We've all worked with constraints for 30 years. We're just beginning to incorporate this other constraint through very significant commitments that we will reach. And that is being incorporated into the hurly-burly of investment. What happens at a UC or an underwriting committee at the asset class level? What happens at an investment committee where my colleagues and I will see something and the CIO ultimately has veto? It just becomes part of the architecture. It becomes yet another buttress to this edifice that we call an investment fund. And it treats all those constraints in the appropriate fashion to meet our objectives. We have one overriding objective, which is the actuarial health of our fund and our fiduciaries. And we have these subordinate or subsidiary commitments and subsidiary obligations, which are part of the investing process. Can't use too much risk, can't use too much capital, can't use too much balance sheet, can't use too much carbon. To me, it's, as you say, this is investing.
Just investing. Okay. That's really helpful. So carbon, I see that as sort of a risk, as a constraint, as you've put it. Another issue that is getting more and more discussion is biodiversity or natural, where the economist in me says, well, carbon's a negative externality because it's, you impose bad things on other people, but actually biodiversity, the positive externality, if if the trees are standing and the birds and the bees get to live there, that's a positive externality. So how do you think about, have you begun to think much about investing in natural capital with both the goal of earning return and also protecting biodiversity? How do you think about that?
Yeah, so we are thinking about that. And let me take a step back and give you our impression of what biodiversity is all about and how it relates to an investment fund like ours. So in some respects, the concerns around biodiversity are very, very closely related to those about climate. As a matter of fact, by improving biodiversity, you can advance the climate agenda a lot. But there are very significant differences too. Climate is really reducible to one thing: greenhouse gas, and 70% of that carbon, although the other ones are more damaging, but there's not as many of them. So in a way, you can really put a sign on the wall with a C on it and a line through it, and what you have to do. And you can be quite mathematical about it. Biodiversity, there's no known quantity of biodiversity. I mean, there are measures of this and there are proxies and indices, but nonetheless, it's not like you can just say I reduced increase the biodiversity by 2.5% for the world. There's no way of doing that. To use the analogy, it's like all politics are local. All biodiversity is local. So you're asking, so how do we think about it? We think about it largely through the prism of impact. Are we having a positive impact or are we having a negative impact? We aim to have a positive impact, and you can invest in these things. And we have invested in these things. There's a company called Green Collar in Australia that we are involved with. And that company is essentially making money by regenerative efforts on farming, stewardship of land, and they're able to monetize this through this carbon credit process in Australia, which is very well advanced and very established, and through other ways of monetizing the biodiversity that is created through their efforts with graziers, farmers, traditional groups. In this case, I mean Aborigines and the like. And it's profitable. So we are learning from these activities, and we believe that it is having a really good effect. I think that we have to think more broadly going forward about biodiversity. There's a rapidity to this that I think is underestimated. Corporations, banks. So as you know, the COP15, which was the biodiversity equivalent of the COPs around climate, was actually held in Canada. It was held in Montreal. We were there. And it's interesting. public officials are not really around. The only one was our prime minister, given his riding was a mile and a half away. But corporate participants were everywhere. And it almost feels like there is a greater enthusiasm and greater activity on this file than there was in the first stages of climate. And if climate is really about energy, which is at first rather resistant to the idea, biodiversity is about agriculture. And they're not resistant to the idea because they see a win-win. They see, like you're saying, a positive externality. It's very heartening to know that large global ag groups are all over this. And there, I think, will be progress towards the goals that were set at COP15.
That's great. And that is that analogy of energy and agriculture is really helpful, because I think that obviously land use, water use, all those sorts of things of agriculture have had some negative effects, but also can be the lever to affect that.
Yeah.
Okay. So I'd be remiss if I didn't ask about the social impact of OTPP.
Worse.
I know you've thought a lot about that. Obviously, primary one is to deliver on your pension promise, to deliver for those families of the teachers. But how do you think about that social impact slightly more broadly?
Yeah. Look, this is another way to have a positive impact, which is, as our ambition is to do that as a plan. But we do that looking through the same lens of risk and return as we would anything else. And we're really convicted about that. And I'll tell you why. When we look at some of our existing companies and companies that we have recently got involved with, we detect value being created as a result of the social impact that these companies provide. We have not announced anything. This is all pilots that we're doing internally. So, I'm not going to tell tales out of school until we're ready to do that. But what I would say is that as we survey some of the things in this domain, we are more convicted than ever, as I said, that what really the social impact piece is about is companies delivering a far more pervasive and far more enduring value to the services they provide or the role that they play in a certain economic ecosystem that is actually providing a more resilient and more wide-ranging level of value than some other kind of companies. So companies that provide, for example, training or education that affect not just the individual, and you can calculate the amount of revenue that this person has or income that they've been able to achieve as a result of this lift, this sort of lift that they've gotten through either training, education, or a combination of the two. But then you start thinking about the value that is then transmitted to the family of that individual, and the family of that individual, and the community that that family lives in, wherever that may be. And all of a sudden you start recognizing the more you're able to understand those different dimensions of impact, or actually looking at layers of value that customers will want. And so actually, we think that these are markets. In some cases, they're new markets. And to me, the challenge for an investor like us is to begin to think about impact more broadly as new markets that don't even exist today. We got to find out what those markets are and try to gain, while at the same time delivering what we think those new markets deliver, which is demonstrable greater value. And so that's a very optimistic and we think a very investment specific, conviction oriented view on social impact, which is not to take anything away from other activities that have impact, but we have a very specific job. And our job is to invest, to seek growth for our fiduciaries, and to have a positive impact altogether. And this is the way we have to think about it. But we think it's the right way. And the only way ultimately we'll all know is as we evolve and build this over time, whether we're able to generate the value our intuition tells us. But so far, I'm optimistic.
Right. It's sort of that multiplier effect of the impact. And then you can,
yes.
Right.
But that's
exactly.
value. That's the textbook definition of value,
That's
actually.
right. That's right.
Yes.
Right.
Yes.
All right. Well, last question for you is, we've talked a lot about some of the issues that people are grappling with today. You're obviously on a lot of them. But as we look ahead, if we were having these conversations a few years out, are there other things that you see on the horizon? What are we going to be struggling with in a few years that we really need to be, as you said before, preparing and acting and innovating for it, now? What should we be
Yeah.
doing our homework on now?
Well, it's a very hard question, of course. Let me just say a couple of things. I try to do this with some level of humility because I really have no idea. Let me say two things. The first is, I think that the investment mindset has to go through a further evolution here, away from the experience space and technical touchstones of investing, particularly in private assets, but also in public assets. I think I think we're going to require a significant adjustment of that mindset, which is comfortable with risk defined differently. We've defined risk as sigma, essentially, but that's based on known inputs, right? I always say the difference between risk and uncertainty is that in uncertainty, you don't even know what your starting point is, right? And with risk management, you do know, right? And you're saying, well, this could happen or that could happen. I think we have to get good at managing uncertainty, and that's a different mindset, and it requires a different set of, or at least partly different set of managerial and investment acumen. So I think that's something that institutions across the board are going to have to struggle with. And it's a combination essentially of a vision combined with really strong human capital development. The second thing is, I am of the view that we need to normalize crises. We cannot think of crises as things that everybody stops and, nothing else goes on because, don't you know there's a crisis? We have to normalize that and recognize that there are going to be things that happen that are not in the rule book, not in the guidebook, that we're going to have to just kind of roll through and continue to maintain a trenchant focus on our ultimate objectives. And I think that'll happen. I think it's already happening, actually. And I think that normalization process is critical to maintaining any kind of composure as an investor. Now, I will tantalize you with one thing, that more substantive point, because I think you're looking for something a little bit different. And I would say that the transition to a low carbon economy is going to go through many zigs and many zags. And I think there was an expectation 5 years ago, that this was a linear process that was knowable. And I think it's actually quite a jagged process. And we all know where we're going, and we're absolutely committed to it. But I think there's going to be some disruption along the way. Disruption can be defined in many different ways. One of them is disruption for households and disruption for economic ecosystems, whether it's manufacturing base, whether it's other necessary components of our economic system. And I think they'll be in a lot of different places. I think we're talking about North America, we're talking about Europe, China. I think that is something that is part and parcel of a necessary process, but a process that it's the first time in world history that an energy transition is taking place from the top down. And it's for good reason. It's an existential risk. But by its very nature, that makes mistakes more likely than a transition that takes place based on economic actors making economically utilitarian decisions and bringing about a transition, which you could argue happened from coal to oil, say, or from wood to coal. But this transition, however necessary and existential a risk it addresses, it's going to be complicated. And I think that's something we need to gird ourselves for and try to find opportunity.
Yeah. Complicated, jagged, and, some creative destruction along the way. And that's, as you said, creates opportunities, but will also, create some missteps, I'm sure, as well.
Yeah. And it would be weird if it didn't, actually.
Right.
But we've got to do it. So,
Right.
I mean, it's in a way, it's just gonna, we just have to keep on keeping on.
Right. Right. And I like your composure through crises. It's not, not it's sort of a crisis of the day rather than
The end of
um
the world. Yeah.
in the world every time that
Yeah.
something doesn't go according to the playbook. So,
Right.
okay. Well, thank you for your long-term outlook, for your support of FCLT Global. We really appreciate your time and attention, and obviously your input into our work. And we're certainly glad that you're managing the money for all the teachers of Ontario. Too bad it's not broader than that. But thank you very much
Well,
for
thank
your
you. That's nice for you to say. Yeah, it was a pleasure. Really great conversation, and very happy to help out in the future.
great. All right. Thanks, Jonathan.
Okay. You're welcome.
That concludes another episode of Going Long with FCLT Global. We hope you enjoyed our conversation today and encourage you to continue exploring our resources and research at www.fcltglobal.org. If you enjoyed today's episode, don't forget to subscribe, leave a review, and share with others who may find value in Going Long with FCLT Global.